Are cash balance plans the new pensions? Will I, as an entrepreneur, be better off using one rather than a traditional pension or defined benefit plan? Should I use just a simple 401k plan? In fact, what is a cash balance plan? These are key questions many a small business owner in today's highly retirement/tax driven era is asking. Hi there, my name is Kenner French. I'm with Vast Solutions Group. We're the nation's premier tax and financial engineering firm for entrepreneurs. We specialize in qualified plans. In fact, we have a number of staffers whose sole purpose is to work with qualified plans, administrating such plans as 401k plans, profit sharing plans, defined benefit plans, and finally, cash balance plans. We've been in business for over 50 years. We have a unique expertise in administration of these types of plans. We're here to help small business owners to succeed in any way possible. Now, in corporate America, pension plans are fading away. Only 16% of Fortune 500 companies offered pensions to full-time employees in 2018, according to some research. In contrast, legal, medical, accounting, and engineering firms are keeping the spirit of the traditional pension plan alive by adopting cash balance plans. Now, owners and partners of these highly profitable businesses sometimes get a late start on retirement planning. Cash balance plans gives them a little bit of a chance to catch up. These defined benefit plans are age-weighted. The older you are, the more you can potentially sock away each year for retirement. 2019, a 45-year-old can defer as much as $168,000 annually into a cash balance plan. A 55-year-old, as much as $255,000 potentially. These plans are not for every business as they demand, generally speaking, consistent contributions from a plan sponsor. Even so, they offer significantly greater funding flexibility and employee benefits compared to standard defined contribution plans such as 401k plans. How does a cash balance plan differ from a traditional pension plan? In a cash balance plan, a business or professional practice maintains an account for each employee with a hypothetical balance of pay credits, i.e. employer contribution plus interest credits. The plan's objective is to pay out a pension-style monthly income stream to the participant at retirement, either a set dollar amount or a percentage of compensation at that point. Lump sum payouts are also an option, by the way. Each year, a plan participant receives pay credit, typically equaling about 5 or 6% of his or her compensation, augmenting by interest credit. The interest credit, by the way, can sometimes be linked to a treasury yield or corporate bond yields or what have you. Now, as an example, how credits are accrued. Let's say an attorney, let's say Jessica, she earns $175,000 annually at XYZ Group. She participates in a cash balance plan that provides 5% annual salary credit, 5% annual interest credit once there's a balance. Jessica's first year pay credit would be $8,700 with no credit, as there was no balance in her hypothetical account at the start of her first year of participation. For year 2, convenience sake, let's assume there's no raise. Jessica would get another $8,750 pay credit at an interest rate of $8,750. Now, that would equal $437. So at the end of year 2 of plan participation, her hypothetical account would have another $17,937. Cash balance plans are commonly portable. The vested portion of the account balance can be paid if an employee leaves before retirement date. Now, an employer takes on considerable responsibility with a cash balance plan. The plan document states that annual contributions must be made either in the form of a percentage of pay or a lump sum. An actuary, which we employ, needs to advise the employer and help the businesses determine yearly contribution needed to appropriately fund the plan. The employer effectively assumes the investment risk, not the employee. For example, if the plan says it will award participants a fixed interest, let's say a 5% credit each year, and asset performance does not generate that large a credit, the employer may have to contribute a little bit more to the plan to fulfill its promise. Now, Cash balance plans must cover at least 50% of the employees or 40% of the firm's workforce, whichever is lesser. They can be used in tandem with 401k plans. Now, cash balance plans typically cost a company between anywhere from $2,000 to $5,000 to create and between $2,000 and $10,000 per year to run. That may seem expensive, but the nature of the cash balance plan offers, well, owners the potential to keep excess profits earned above the annual credit owed to employees. Now think about that. Benefit allocations are based on career average, not just the best years. In traditional defined benefit plans, the eventual benefit is based on a 3 to 5 year average peak employee compensation multiplied by the year of service. In a cash balance plan, the benefit is determined using an average of all years of compensation. Cash balance plans are less sensitive to interest rates than old school pension plans. As rates rise and fall, liabilities in a traditional pension plan fluctuate. This opens a door to either one of two things: overfunding or underfunding. And underfunding is a major risk potentially right now with such a low interest rate environment. By contrast, a cash balance plan has a relatively minor variation in liability valuation. A cash balance plan cannot be administered with any degree of absent-mindedness. It must pass yearly non-discrimination tests. It must be submitted for IRS approval, generally speaking, every 5 years instead of every 6. Obviously, a plan document must be drawn up and periodically amended, and there are usual annual reporting requirements, et cetera, et cetera. Ideally, a cash balance plan is run by a highly compensated employee of a firm who acts within their prime earning years. In the ideal scenario for non-discrimination testing, or the HCEs are 10 to 15 years older than half or more of the company's workers, typically speaking. If trouble occurs and a company founders cash balance plan participants have a degree of protection for their balances. Their benefits are insured up to their maximum value by the PBGC, or Pension Benefit Guarantee Corporation. If a cash balance plan is terminated, plan participants can receive their balances as a lump sum or request periodic payments. Since 2006, the number of cash balance plans has grown by about 20% per year. The passage of the Pension Protection Act cleared the way for their broad adoption. Today, some businesses even have a dual profit sharing plan and cash balance plan. Maybe it's time for your firm to look at such intriguing alternatives to traditional pension plans or traditional 401k plans. If so, please contact us. Look us up in the web. Either one. To contact us, 888-808-8278, or on the web, www.vastsolutionsgroup.com. Either way, thank you for taking the time. If this has been of value, please refer us on to a friend. We are in the business of helping small business owners to grow and better their situation. Once again, my name is Kenneth French, and it's indeed been a pleasure to spend this time with you.